Hi, Katie.
Good morning, Dale. How are
Uh,
you?
Singing in a joyful mood ahead of the NFP.
It's
Anyway,
a good song. I love it.
it's so great to have you back, and there's so much ground to cover. And I recall seeing you on CNBC, I don't know, a few weeks ago, and you did say that this market rally carried a little further than you thought it would, and that 3,900 would be the battleground, which Thursday it was tested, had a nice 2 day rally out of it. So my question to you is the market going to hold this 3,900? What happens if it takes it out? Do you hold out any technical views that we could have a little bit left to the upside, maybe like 4,300 or something like that?
Yeah, I mean, listen, it was a very strong up move in January, and yet now most of it's been given back by the market, and it puts the S&P 500. Hopefully, can you see the screen?
Yes, we got it.
Okay, great. This is the daily bar. And you
Okay.
see here, this is our trusty cloud model. And the cloud is a
Yeah.
great gauge. It's a very forgiving gauge of support and resistance, typically more forgiving usually than the 50-day moving average on a daily chart, and more forgiving than the 200-day moving average on a weekly chart. And that's what we've been watching as our key support level in here. So it previously was around 3,900, and it's actually risen over time such that tomorrow it is around 39.80. So at
Okay.
current levels, you can see how easy that would be to get a breakdown. What we're seeing from the indicators is more negative than positive, certainly. The oversold bounce temporarily preserved support, and it was actually off of a DeMark signal. If you see this nine, the green nine was
I
a
do.
minor counter indication that usually has implications for 4 days or so, or 4 bars before you get a resumption lower. In fact, you saw something very similar here, a nine right near the cloud, brief bounce and failure. We hope it doesn't have to be this dramatic, of course, but
Okay.
there is risk, I think, if we do see a couple of closes below this cloud-based support.
Okay, so the takeaway is the DeMark signal was for a short-term rally, which it got. Doesn't add any conviction to the long side, and you're looking for cloud support. Could be taken out tomorrow on a strong or better than expected or as expected NFP and the numbers inside. So if we're going to take that out, let's say we do, Katie, and we take it
Mhm.
out, what are you looking for? Maybe is 3,800 a possibility on the downside, or would we be on our way to take out the October lows if we start closing back under the cloud?
This is a weekly bar chart, so you can see
Okay.
really the same indicators, and you can also see how these stochastics are pointing down, which is
Yeah.
really one of the primary reasons that we do think we'll get that short-term breakdown and see a little downside follow through. As you're well aware, in a range-bound environment, which arguably the market is in already, these stochastics tend to be really helpful and timely. They do force us to be a little bit more short-term, perhaps, than we want to, but in a range bound environment, you can't really assert a long term directional bias anyway. So we want to have indicators like this on our side. Now pointing lower. If we do see the breakdown for us, there is interim support around 3,800. It's a minor level, but we think that breakdown would increase risk to this, which is 3,505. It's a
Okay.
50% retracement of the uptrend off of the COVID low. It obviously captured the October low. And if
Right.
you look back in this area, it did capture sort of a previous consolidation area. So a pretty strong support level. It is evident off of that October low. Our hope is that we see a higher low versus this level, but that's our sort of risk framework that we're working within.
Okay, and you made a great point, Katie, about that, you know, it's shorter term. And this whole market has offered great swing trade opportunities, but very frustrating for both bulls and bears to have
Mhm.
long-term looking to catch the next trend when it's trendless. So you have to take what the market offers you, and what you're saying is you have to be tactical now rather than trying to be look ahead 6, 12 months on a position. You have to shorten your time horizons and take
Mhm.
what the market's given you.
That's right. And we do think this is a transition year that will allow the market to emerge from this bear market cycle. And yet, I think your point is a very good one, that it's frustrating for both bulls and bears. That's the nature of a trading range, where you have
Yeah.
swings in both directions that can be somewhat harrowing, and also not really easy to leverage. If you're asserting positions, you really have to be very nimble in your positioning to take advantage of that type of environment. And some folks are completely attuned to that, but many are more long-term in their orientation. So I think the key here will be not to perhaps overtrade in this environment, to try to just keep the indicators on your side over your preferred time horizon. Know that it's okay to be out of the market, especially at a time when we have alternatives. There is an alternative now.
Right.
So, we feel that there
5%
is,
money.
5%, there's certainly an appeal to that when there's lower risk. So
As you talk about this, I've noticed the narrative of the range trade
Mhm.
gaining traction for the last few weeks. And right away, my mind starts thinking, well, everyone's embracing that we're in this range. They don't have to worry about a breakout from the range, just trade the range. That breakouts are going to happen on both sides, maybe first to the downside and then to the upside, because everyone's embracing we have a range now. I saw you before we had this October rally, and you were talking about the VIX, and it's something you rarely talk about, but you had come up with that you thought there might be a 38 target in VIX. I didn't know that you would make any kind of projections in VIX, but I'm curious how you came to that conclusion. And do you still feel that way?
Yeah, and it's tenuous, right? I mean, we have
Yeah,
still a high volatility regime at hand, based on the fact that long term, this is the VIX on a daily,
right.
this support level is intact, and that's at 1845. You can
Yeah,
see it's a very well tested level. And, within that sort of framework, you have a short term oversold condition right here. And that
yeah.
suggests that we'll see a bounce off of that support yet again. We saw this breakout above the 50-day moving average as something that would trigger that so-called sort of volatility event, is what I'm calling it, which would require that move into the mid 30s, right? So you can
Okay.
see, I mean, the resistance couldn't be any more well defined, right? Where it just
Yeah.
seems to have peaked right around that level. That defines the upper boundary of the range. And we still can't rule that out with this oversold reading, support
Yeah.
intact, a recent
It looked
breakout.
pretty good. It looked pretty good on that initial pop towards 24
Uh-huh.
and then gave it back, but it looks like closes over 24, 25. If you take the low at 17, is going to give you at least 32. And
Well, and I mean, look at these past breakouts above the 50-day. They
yeah,
didn't yield necessarily that instant upside follow through. You would see an initial breakout and
yeah,
then a pullback.
yeah.
Here it was the 200-day, but a little breakout and a pullback. So it's not completely out of line with historical action from the bear market cycle. Where it would go against this, right, would be if we've actually emerged from the bear market cycle, which would mean a sort of a newer low volatility regime that I think we would all certainly welcome. And what would be
That's
triggered?
history.
Yeah.
We all want to go back to the future. I mean, back to
Yeah,
the
I know.
past.
And listen, we'd love to see that 18 and a half area broken decisively, because that would tell us that this sort of higher
Okay.
volatility regime has a new lower floor.
Okay. So pay attention to the VIX. It looks
Mhm.
like we're at one, we're at critical support. It's one way or the other here for this as well. Your view on Dixie, Katie? We bottomed at par 55 and have rallied up to 5.5, almost
Mhm.
about a 38% retrace of the big hit that we took from 114.5. Um, to me, watching currency action over the last few months, and I know the dollar's getting a little bit of a bid here. Um, the dollar has its gains have been hard fought, and only 38% at this point. a lot of people turning friendly, going back to the milkshake theory, et cetera. Where do you stand with it trading back over 104, back over 102?
I think we will see a little bit more upside follow through. We had a recommendation in our Substack newsletter in UUP, and we've stayed with that. But it is feeling like it's getting a little bit long in the tooth. And we say that in part because of this intermediate term overbought reading in the weekly stochastics. But notice also, I love this chart. It's a weekly cloud chart, and you can see the corrective phase came into support based on that cloud. And now it's towards the upper boundary. So right up in near the upper boundary of the cloud, and also per the 200-day moving average, which is somewhat replicated by the 40-week here. This is our resistance area.
106 level, the 200?
Yeah, it's about 106.5 or so.
Okay.
I can show you on this one. It did manage to get through the daily cloud. So that's why we're staying with our sort of dollar bullish recommendation for now. But you can see the upside, is somewhat limited when you look at the 200-day being around 106.60. So I suspect that we'll see a little follow through, then it'll start to peter off. And we believe that the dollar overall, in the same way that equities we think are perhaps in a range bound environment, still with a lower bias initially, we suspect that the dollar and euro in turn have entered a trading range. And you can see this is on the monthly chart. Look at what happened to this monthly MACD.
They converge.
It's really converged. And then at the same time, we have just a neutral reading here in the monthly stochastics. So to me, it feels like we'll probably see just a period of backing and filling. There is some support around 102. That's quite strong.
Okay. I think that what a lot of market participants might have a harder time wrapping their head around is the long end of the yield curve, something like TLT, especially with Powell talking like a mega hawk this week that really, put pressure on gold and silver collapse, a dollar rallied, S&Ps took a hit. And yet when I look at TLT, so far we've left a bit of an island bottom there, and off the lows that we had I don't know, several months ago, it almost looks like a bullish pattern to me in TLT, that if we could get over a resistance area, you could be talking about a pretty massive bond rally. And I'm wondering, could we, if we get the breakdown in S&Ps, finally get old school reaction to where bonds can work in a risk off environment instead of leading the market into a risk off environment?
Right. And I do think the point on the relative is certainly high conviction right now. And that if you look at, this is the ratio of TLT to the S&P 500, there is a DeMark buy signal short term, suggesting that we'll get outperformance. Now we have to trust that this 200-day moving average, which has acted as very clear resistance for the ratio over the past cycle, that it will remain intact until it otherwise. But you can see a potential higher low with a relief rally in relative terms. So we feel pretty confident in the ability of Treasury, bonds and ETFs to outperform. And then to your point, that I see what you're saying with this island reversal. Now you also
and look to the left in December, it was the same way at the last low. And even doesn't this look corrective? After that first launch, we've corrected in time, and a lot of time going back to November. That whole overbought situation, not as much in price as in time.
Mm-hmm. Yeah. And I do think that this October low is the start potentially of like a bottoming process. The emphasis still there is on process. I mean, we do have a reaction to a long-term oversold condition. But that would, of course, trust that yields are getting into a range of their own. We do have that bias where we think Treasury yields, they look higher near term. But when you look at the monthly charts, there's actually some signs of exhaustion on those same DeMark indicators that they have no implications for the next month or two, but they do suggest for the next 7 or so months that we will see just more middling sort of sideways action overall from Treasury yields. And listen, that would be a departure from, the trends that we've seen, of course. So a departure from this downtrend in TLT. We actually yesterday, just if you can sort of humor me here, we launched a new report. and it's called ETF Navigator. In this report, we have all the fixed income ETFs. So we're publishing this on a weekly basis. We're really excited about it. It was a labor of love, but and then week over week,
anything with love in it wins.
Yes. So each week we'll highlight these sort of US equity ETFs, going down all the way to the thematics like cloud computing, et cetera. This week we started our inaugural report with fixed income. So we showed all, TLT, IEF, even the muni bond ETFs. And here you can see them, they really are, of course, very positively correlated. SHY here on the right is coming into the support already, right? So this is 1 to 3 year sort of a representation there. And you see the oversold condition. So I would call that at a proving ground. And we do have some signs of short-term downside exhaustion as that level is tested. And here you can see other bond ETFs as still, being within their downtrends based on the weekly cloud with weakened intermediate term momentum. But notice here also, they are more oversold certainly than equities. And we feel that these ratios are HYG, for example, versus the spiders, you can see that they're range bound, but poised for an oversold bounce in following what we just saw on TLT.
Yeah, the further you go out on the curve, the more constructive the technicals are.
Mm-hmm. Yeah, I would say that.
So with this, are you a believer that we should be ignoring the message by the severe inversion in yield curves across the board?
No, you know what? I mean, we had the first inversion, in July of last year. And to me, it's reason to be cautious with equities because we don't tend to see the equity market bottom outside of a recession. So I think it's certainly something to be respectful of. And it just keeps us in that sort of risk off mode and being wary of breakdowns, being respectful of downturns. So I don't think it's something to be ignored. It certainly is getting a lot of press just given the extremes, but it's already been an overhanging issue.
Okay. So during this recent run that we had, going back to the employment report where 10-year yields went from 3.30 to 4%, 4.08. In fact, last Friday, the market came off. We've had a dramatic correction in precious metals, silver from 24.5, gold from 1960 to 1800. I started building a minor position yesterday. Am I crazy? Because I look at GDX, and as weak as the bullion has been, we haven't even retraced 61.8 in GDX yet.
Yeah. Well, so GDX actually does have a counter trend signal. So somebody asked me yesterday if they should hold a position in Agnico Eagle, so AEM. And there's really not much redeeming about that chart in particular, but to keep in mind the top-down influences, which of course are quite strong with anything commodity related. This is GDX on a daily chart. As much as you can't make a case for it based on the indicators, the DeMark indicator here would suggest that it is overdone on the downside, at least short term. So these signals on the dailies will have implications for a minimum of about 2 weeks. So I want to give this signal in GDX a chance to work, just knowing that you could see some defensive positioning, of course, if we do get a broader equity market breakdown. And you can see on the risk level for GDX, it gives you a really nice defined, essentially stop loss. So at 25.97, an open below 25.97 on GDX would stop out that signal. And therein, I think, would be a fair stop loss.
25.97, just FYI, is 61.8 back, where I'm looking to add to my positions, not get out of my positions. So I'm just saying, maybe I should be getting out of my positions, but I usually give 61.8 a chance, and there'd be pretty good divergence between the last low. So anyway, that's how I'm structuring it. I think it's a buy zone. Then I'll find a stop after that, maybe, risk 100 or so to see if we get a turn. But that to me is a buy zone. But interesting that DeMark is showing it's way overdone for at least a bounce in that.
Yeah, and we're definitely getting there. And this is another DeMark indicator that it doesn't have to be consecutive, but it could flash another signal either today, tomorrow, or early next week. And not all the signals are timely, but there's enough that are timely, like this sell signal, that it always, makes us kind of perk up.
Okay, so I mean, it kind of says cloud-wise that we could have a breakdown in the S&Ps, and probe lower levels. Bonds are shaping up for potential recovery on the long end of the curve. Gold could be there for a counter trend move. So I think we have it diagnosed. And I would think that if the dollar was going to rally one more time, it should do it then.
And I would just add on Dale that where things would look better, right? Because that's always something good to have in mind, especially with this volatility in both directions. This weekly cloud chart of the S&P 500 shows the resistance. It moves down to about 4,200 in a week or two. And that's pretty well aligned with the early Feb high. So a breakout, very simply, which we can all identify about that 4,200 area would start to really improve the chart in terms of resistance, but also likely have a positive impact on the indicators, which still at this point, point lower.
The only thing we can control, Katie, and that's knowing when things change and having your line in the sand for when things change. So great to bring up. Should always know when the picture is going to change technically in whatever you trade. How's the ETF going, Katie?
Yes, so far so good. In falling with our views, it is still sitting very heavily risk off. So we have the positions in the treasuries, short-term treasuries, long-term treasuries. It holds also GLD, so for gold exposure, and has stayed with energy, the energy complex. As much as we've seen a loss of momentum there, it still has maintained its uptrend, both in absolute and relative
terms. Are we close to it abandoning that? Because I looked at the XLE.
Right. Yesterday. Yeah. And that's the position as XLE. So I would, so here we have, you can see on the monthly chart, and remember, this is very long-term sort of strategy that we're using here. Look at just the slope of the 12-month moving average. You can just see it's not down and it's not even flat, but it certainly seems to be rolling over to some degree. We also have a DeMark issue here. The MACD is still positive, but has converged a little bit. So certainly some longer term indications that it is, moving into more of a range bound environment of its own. And yet we do look for crude oil to get up into probably the mid 80s even. So we still want to stay with the exposure and leverage that, knowing that a lot of the energy stocks look poised for an oversold bounce and offer actually a lack of correlation to the S&P 500 that we're welcoming right now.
Should they break down, would only add fuel to the decline in S&Ps, don't you think? Since they were really the relative leaders forever.
They don't have a big footprint, but certainly could affect sentiment to some degree. What I will say is that the sector rotation that we're seeing from a longer term perspective is actually really promising. So if we look at, I'm going to try to pull this up here. If we look at the relative rotation graphs for the S&P 500 sectors, and if we take a 6-month view, you'll see that it's quite promising in terms of favoring the sectors that tend to exhibit leadership during bull market cycles. So, and of course, there's a major influence here from the mega caps, but it's communications, discretionary technology, still solidly in this lagging quadrant of the RRG. But here's the defensive sectors, and you can see that from this kind of 6-month perspective that they've taken a downturn. And that just means, it doesn't mean they're underperforming, that significantly, but it means that they've lost momentum. And you can see it in energy as well. So this tends to make this clockwise rotation. And it would be something that if you picture in the next 6 months that we could actually have something meaningful.
Okay. Who developed this?
This is Julius de Kempenaar. He's based out of the Netherlands, at least was when I last spoke to him, and it's his proprietary model, and it's a really fantastic, I'd say, data visualization tool. Yeah.
Yeah, I never saw it. It's like the wheel of asset classes
Mm-hmm.
spinning
Yeah, you can
around.
really see cyclicality too. It's great.
Yeah, spinning around like a watch.
Mm-hmm.
All right. Well, I set my watch by a lot of things that you say, Katie. I think that you're one of the best out there. I
Thank
turn the
you, Dale.
volume up when I see you on TV and appreciate your giving spirit. Best way for people to continue to follow your excellent work, and maybe something will happen in cannabis one of these decades.
I
What do you
appreciate that, Dale.
think?
I mean, the easiest way to sort of get in touch is via our website. It's fairleadstrategies.com. And with this new report, folks might want to consider signing up for like a free trial. We give a month away, and we're hoping to get a lot of feedback on that to, make sure that it's helpful.
Okay, so everyone go to fairleads.com, Katie.
Yeah, I can put it in the chat room if I
Yeah,
can.
why don't you do that? And you could, and follow Katie on Twitter at Stockton Katie. And I really love to hear what Katie's thinking as frequently as possible. So again, my Trading Warrior sister, and appreciate the tweet that you enjoyed this as much as I do getting together, and look forward to 3 months of great trading before we speak again. I'm a fan.
Same here.
Can
Me
you tell?
too.
All right, we'll send each other 8x10 glossies. And thank you, Katie, and thanks for putting up with my Kenny Rogers imitation.
No, all good. Have a great day.
All right, Katie Stockton, everybody.
Take care.
All right, everyone, you could join the team in 16 minutes on the Morning Edge. You're welcome, everyone, and glad to bring top elite type of technicians like Katie to you, and hope that you glean something that you could put in your toolkit and consider following Katie. Definitely, you should. And I don't say should a lot. So don't just count your pips, count your blessings. See everyone tomorrow. We'll trade the NFP, which should be no freaking problem. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.